Hello, everybody, and welcome back to SEC Roundup. My name is Nick Morgan. I'm the co-founder of ICANN, the Investor Choice Advocates Network, and the co-host of SEC Roundup. And with me, as always, is my co-host, Tom Zucchero. Good morning, Tom. How are you?
I'm well, Nick. How are you doing this morning?
I'm doing particularly well because we're joined by John Gulliver, who is the executive director at the Committee on the Capital Markets Regulation. John, thanks so much for joining us.
Great. Happy to be here, Nick. Thank you. And Tom.
And so the reason we wanted to have you on is your organization, and you published an op-ed recently in the Wall Street Journal titled "The SEC Targets Private Capital," and you addressed a number of issues in the private capital sphere. As listeners of this podcast will know, the SEC has been particularly active in rulemaking as it pertains to the private markets. So we wanted to get your views on a couple of things, and in particular, an issue that came up a few months ago and seems to be continually on the SEC's radar for rulemaking, which is this notion of securities held of record. Professor Tom, can you give us a little background on what does it mean? What is this securities held of record? So give us a little context for this.
Yeah, happy to do so, Nick. So this rule has been around for a long time, and it deals with when a private company is forced to become a public company and start filing periodic SEC reports. And the rule basically says that once you pass a threshold of number of investors, your company is automatically deemed a public company and has to submit to the SEC reporting regime. The current rule is 2,000 investors or 500 non-accredited investors, and whenever either threshold is crossed, the company is deemed to be a public company. A lot of private companies don't want to determine their own timing for when they become public. They don't want to have it dictated to them just by the number of investors they have, and some companies aren't ready to be public for a variety of reasons. So the current issue involves how do you determine investors? So many investors invest through their brokerage firm, and that firm holds the shares in street name. So from the private company's perspective, they don't see all the investors of a particular brokerage firm. They just see the brokerage firm who holds in the street name. And the SEC's new rule is attempting to pierce that. And John will address what happens if it's adopted, but it would change the counting of investors.
Well, and so thanks for that primer, Tom. And John, let me turn to you. One of the phrases in your op-ed was that, and you weren't talking just about that issue, you were talking more broadly about the SEC's attitude toward private markets in general, but you described it as a full frontal attack on private markets. So with regard to this, and it's not yet a proposed rule, right, John? I think it's on the rulemaking agenda. There's been some discussion, but can you give us a little bit more detail on what it is that we think this proposed rule may entail and how it may harm or benefit the private markets?
Yeah, that sounds great. Thanks for the summary, Tom, and the question, Nick. So I guess, to start, I would just take a really big step back and say that, the reason we wrote our op-ed is that, the SEC has been piling on rule after rule onto public companies in the United States and public funds, mutual funds, ETFs. These markets are highly regulated, and it's very costly to be a public company now. And as a result, you're seeing that there are fewer public companies today than there was 30 years ago. You're seeing foreign companies are no longer coming to the United States to go public because they know if they do, it's going to cost them a fortune in compliance. Meanwhile, our private markets have been booming. Private companies are raising capital at greater amounts than ever before. There are close to 100 there are hundreds of unicorns, private companies that are worth more than $1 billion. So some of the most exciting companies in the world, like SpaceX and OpenAI, those are private companies. Retail investors can't invest in these companies. They are exclusively accessible through private equity funds. And these private equity funds have performed incredibly well. So the private markets are doing very well, and retail investors are pretty much shut out of them. So the SEC has now decided, well, we need more regulation in private markets. And why they've made that decision, I don't think there's a clear policy rationale behind it. I guess the idea is that they think that these sophisticated private equity funds, they need protection. So they need additional disclosure and restrictions on how they can deal with private companies and with their own investors. But we don't really think that's the case. We think these are highly sophisticated investors, and they don't need the protections in private markets that exist in public markets, the kinds of protections that retail investors actually need. So this holders of record issue is really just one of a few different attempts to get into private markets by the SEC. And the SEC's goal here is essentially to require more private companies to go public. So this would require potentially your SpaceX's and your OpenAI's to go public at a much earlier stage in their growth phase. And the holders of record would do so because now, as Tom said, there's essentially a private company can continue to be private so long as they only have 2,000 investors, and or shareholders is probably the better way to say it. And if those shareholders shares are held by a broker or by a fund on behalf of many investors, then it just counts as one. And this is really common. So you could think of many wealthy individuals having their shares held by Goldman Sachs, for example. So right now, if Goldman Sachs does this for 150 private clients, those 150 private clients that all, let's say, have shares in SpaceX, that just counts as one shareholder of record in SpaceX. And the same is true if all of us invest in one of Blackstone's private funds. Blackstone's private fund, which often will have 100 investors or more, only counts as one shareholder in SpaceX. So as a result, a company like SpaceX, for shareholders of record, likely has only a couple hundred, let's say, and then they're not forced to go public by this 2,000 minimum threshold. But what the SEC is looking at doing now is going through the broker dealer and looking to look at all their private clients and count them as shareholders of record, potentially even doing the same with private equity funds and going through to their end investors. And when you add up all those end investors, you very likely will see the largest private companies at the very least having to go public. And in our view, that's an issue because these public companies are subject to extensive regulatory requirements, and that can impose burdens at an early stage in their growth cycle that is really not going to be the best outcome for them, growing their revenues and sales and jobs for their workers. So we think this is one potential major step into private markets, among others, that really wouldn't be the best outcome for our capital markets, these sophisticated investors, or the companies that the country relies on for jobs.
Sounds like a significant issue, John, and one that we should probably all be paying a little more attention to. And it sounds like it's on the agenda potentially for this month or next for the SEC to consider. So we'll keep an eye on it. Thank you for that great overview, and we appreciate you coming on SEC Roundup. Tom, thank you, and for the rest of you, please come back for the next episode of SEC Roundup.